Trust and Estates Weekly. I'm your host, Kevin Bemmel, and we're here every Monday at 10 a.m. Pacific time to talk about everything related to estates, probate, trusts, and both from the standpoint of doing your own estate and retirement planning, as well as for professionals who are helping people do this. And so today, I'm happy to have a new friend and guest, Tom Kerrins. And Tom has been in the real estate mortgage business for, I think, your entire career, if I'm not mistaken.
Well, about 35 years altogether.
Okay, great. 35 years. But more particular to today's episode, and hang on one second. Oh, nope, that's not what we want to do here. Something went hanky to set us up like this. But anyway, so Tom is a certified reverse mortgage professional, and he's going to talk about this tool and explain how it can be used for the estate planning and retirement process. So, without any more ado, I'm going to turn things over to Tom, and I'm going to kind of be the audience here because unlike other topics that we deal with, I have very little knowledge about estate planning. I mean, about reverse mortgages, and so I'm very interested to hear Tom's presentation. So, Tom, do you want me to bring up your presentation?
That would be great, and thanks for having me. I really appreciate the time.
Oh, wow. Hang on one second here. Let's see. Oh, here we go. This is what I'm looking for. Oh, gosh. It won't set back to the orientation we had before. That's so bizarre. Okay, orientation selection not available while live. Okay, well, Tom, can you see your presentation well enough?
Yes, and I can work with the slides I have. So,
okay.
So let's get started. And basically, I think the subject that we really want to cover is retirement, how a person can enhance their retirement, and what I like to call self-actualize in retirement, meaning get all of the things that they want, reach their full potential. And so and how they would do that. One of the elements that they can do is by positioning their real property assets and using those to help in the process of getting a good retirement. So I wanted to talk a little bit about myself first, and then look at retirement and the challenges of retirement, and then retirement planning with real property, common strategies, how to create happiness and security in retirement, and then finally talk about self-actualization. So,
okay.
So a little bit about me. I have 35 years as a licensed mortgage broker and real estate broker. I'm the broker of record for Square One Financial, and I also am a certified reverse mortgage professional, or CRMP, which is a designation that the National Reverse Mortgage Lenders Association confers on people who do the education, pass the test, and do the work. And so there's approximately a little bit over 200 people in the country that have that designation. I'm one of them. And then I'm a member and I'm a director of the Tri-Valley Estate and Planning Council. So, and I show a picture of another Tom because he's been very active in the advertisement for reverse mortgages, but I can tell you that I know a lot more about retirement than he does. So,
Tom Selleck is a longtime client of somebody I know, and he supposedly he's a really nice guy, but I wouldn't imagine he knows anything like the amount about reverse mortgages that you do. So
probably not. He's welcome to come on if he'd like to, but
okay, good.
Anyway, so in the next slide, Kevin, we'll talk a little bit about what retirement is, right? Mm-hmm. And are you actually prepared for it? And I saw this thing one time. I thought it resonated pretty well. It talked about the different phases of retirement. The pre-retirement phase, probably in your 50s, early 60s, where you're working hard to accumulate, to be ready for retirement. Then they call it the retirement honeymoon phase when you actually do it and you think, oh my God, this is great. Why did I keep working all those years? Then the disenchantment phase that comes in afterwards, because it's like, okay, yeah, this is great, but am I really going to be able to sustain this? Am I going to really be able to do it over the period of time? And then finally you enter the reorientation phase where you start to think, okay, what do I really have to do to make retirement work for me? And then finally the stability phase where you get it all taken care of because you follow some of these things and it starts to work for you. So the next slide talks a little bit about what is self-actualization. And basically it's just realizing your potentials, right? Fulfilling the things that you can do with your talents and your desires, and the process of becoming everything that you're capable of becoming. So anyway, so on the next slide, let's talk about something a little bit less fun, which is the risks of retirement. And you can see there's a fairly long line of risks here, of things that affect all of us. And by no means are these all of them, but a lot of the ones listed here are health and financial related. So long-term care, the risk of your health in general, medical insurance premiums. You have things such as financial elder abuse, the fact that you'll become frail, the fact that you'll eventually, probably either suffer the loss of a spouse or that your spouse will suffer the loss if you happen to have one, right? So all of these risks are things that people are facing in retirement. And the question is, how do you deal with them, right? Because how do you get to self-actualize if you can't deal with these risks? And then another thing that I thought was really important to touch upon is, it says, how does a boomer head towards hardship in retirement? But this would be for anybody, some behaviors that will really cause a problem with your self-actualizing your retirement. Carrying too high a balance on credit cards, taking your Social Security too early, selling investments, when the market drops, paying too much in housing costs. You can see them all here. And these are also things that can stand in the way of your, gaining the retirement that you really want. And so obviously the question will become, how do we deal with those, right?
Right.
So the next
slide. I can interject. It seems like some of them can be more effectively mitigated than others. So, for example, long-term care risk, right? We can get long-term care insurance. On the other hand, public policy risk, there's not a whole lot we can do to mitigate that, right? We don't have control over public policy. And so we're going to be subjected to that just as a matter of course. Does that seem like...
Yes, I would agree with you, but I would add one other thing. Even the ones that you feel like you can't control, having a stable and properly designed financial situation can help you deal with those and make it more easy and more enjoyable for you to go through those. Okay, so that's the only thing I would say that, that's part of, what we're really looking at. So, anyway, so the part of it that I really wanted to touch upon today is retirement planning with real property. And so if you could go to the next slide, actually. And then, okay, so that's the boomer slide. So the next slide now is retirement planning with real property. And actually you can go to the next slide after that. So in my mind, when you're talking about how you position your real property to help yourself with your retirement, the biggest question facing anybody and the most important, number one decision is, where do you want to live the remaining time of your life,
Mm-hmm.
right? So, for example, do you want to stay at your home? Do you want to age in place? And is your house an appropriate place to do that? Is it where you want it to be? Is it set up how you want it to be? Does it allow for you to, does it allow for you to continue to get older and more frail and still be able to live in the house and take care of it? Can you
Mm-hmm.
financially afford it? I mean, there's a lot of different questions, but that's, one thing. Or do you want to downsize to a more appropriate property? Do you want to either purchase or rent? Um, and then a third choice would be to move into a senior housing community, right?
Mm-hmm.
Or and there are different communities that get progressively more care oriented, right? Starting with just over 55 communities, such as Rossmore up here in Northern California, Laguna Woods, I think, is a big one down in Southern California.
Mm-hmm.
But then also can progress to more like assisted living homes, and then finally, 24-hour care facility, right? So do you want to live in a senior housing community, or do you have the ability to move in with family, or have family move in with you?
Mm-hmm.
So either by the use of an ADU in their property or yours. And so this is a really central thing, because this, in my mind, will really shape your retirement. And to the extent that you can answer this question and know that that's what you want to do, I think that's a really important point, to the whole process.
Mm-hmm.
So we can go to the next slide, which I think is going to be a little bit difficult for
Oh,
everybody to read. But basically, the point of the slide is, and the point of the effort is, what are your current plans, right? And we just touched on some of those. Can you meet your monthly expenses and have a little left over? uh, does your home meet your current needs? In terms of future security, do you think you'll be able to maintain your current standard of living long term at your home? Would an unexpected home or health expense take you off track? So these issues of security, are you going to be able to live where you are, or do you need to make that change? Like going back to the previous, don't go back, but
yeah.
thinking back to the previous slide, which of those choices? And
Mm-hmm.
then also, in terms of the theme of self-actualizing, connection, accomplishment, and growth, because one of the things that we know is that longevity is not necessarily tied to who has the most money, or who has the most toys or whatever, but
Mm-hmm.
it does have a lot to do with who has the best social network,
Mm-hmm.
who is among the people that they want to be with people that are willing to help them, with people that are willing to socialize with them. And does that keep you intellectually active, right, with your age, and so forth and so on. So that's a really important part of that decision as well. And then finally, the actual self-actualization of retirement. Where do you see yourself in 5, 10, 15 years? Do you feel good about your future? And, what are your goals, and what's most exciting to you about your retirement? So you might ask, well, what's all this have to do with reverse mortgages, right? But, this is the framework of how you're going to try to help improve your financial situation. So these are all things that I think that are really important to talk about. And now to the next slide.
Yeah, so if I can just interject here real
Go ahead.
quickly. So
Mhm.
I think you bring up an extremely important point, and I remember now that you raised the issue. I wrote a blog post about this many years ago, probably 10 years ago. When we think of assets and assets for retirement, we generally think of real estate, financial assets, those kind of things. But the most valuable asset we can have are the relationships that we've built.
Yes.
And that is going to have more of a direct impact on the quality of our life, really even before retirement. This is an issue I talk to my daughter about on a regular basis, and I think sometimes we get kind of tunnel focused in terms of which assets are most important, but yeah, I'm really glad that you emphasize the idea of relationships. So.
Well, yeah, and this kind of goes, one is dependent on the other, right?
Hmm.
Because the framework that you have for your home, the framework that you have for your finances, the framework that you have for where you want to live, how you want to live, that's going to affect who your social network is. And likewise, who your social network is going to affect how well, how happy you are and how
Hmm.
well you do, no matter how your finances are, right? So they're very
Absolutely.
important things that kind of interact. And it's just, and that's part of what's really, in some ways, very exciting about this topic, because it is a way that a lot of people haven't thought of. I mean, one of the things that was really interesting was, I don't really put a lot of stock in people like Susie Orman and Dave Ramsey and those guys, because I think that's kind of like McDonald's financial advice, right?
Hmm.
A quarter pounder for everybody, and that's all there is to it. But
Right.
I was listening to her one time, Susie Orman, and she started talking to this person, and she was talking about, well, yeah, your parents, they had a pension, and they had this whole backup, and you don't have that anymore, and so your whole financial thing is totally different. And the thought crossed my mind at that point, well, yeah, that was very true even for my parents. But the other side of it was that my parents didn't own a home that was worth $1.5 million either,
Hmm.
right? A lot of
Right.
people in our audience may very well do, right? Or
Hmm.
900,000 or 2 million or whatever. And
Hmm.
so in some ways, that's kind of a juxtaposition, right? Yeah, we don't have the pensions anymore, but show me the people that had those kinds of housing assets back then. So
Yeah.
that's why a housing asset, and I always, one of the things that it made me think of is, maybe your house is your pension, right?
Right. That is
So
interesting, because I've talked about that, the demise of defined benefit pensions has really changed how people look at and can retire. But you're right. People with defined benefit pensions rarely had the kind of equity accumulated in a house that people do today. So
right.
yeah.
So let's go to the next slide, and let's talk about the three ways to access home equity, right? So
Hmm.
one way to do that is to sell your house and move. And the thought process being that perhaps you will, gain some money, right? That maybe the cost of where you go to will be less than the cost of what you're buying. And one of the things that so that's one way to do it, right?
Hmm.
And you downsize and either purchase or rent. From a cost standpoint, it costs you about 10%. And also, the other thing that you're giving up is that in the tax code, if you sell your house now, you pay capital gains based on the rules, right? The first
Hmm.
250 or 500,000 are could potentially be tax free, but then after that, any gain is taxed at capital gains rate.
Hmm.
Whereas if your heirs inherit your house, they get a stepped up basis in the house, and when they sell it or live in it, then their tax basis starts from the much higher thing. So that gain is all erased. So
Hmm.
that's another, just something to consider when you're trying to decide whether selling and moving is the right thing. And by the way, there is a reverse mortgage for purchasing a house, and we can talk about a little bit about that in a few minutes.
Sure.
Second way is a traditional home equity line or loan, right? So
Hmm.
the thing about that is that what's good about a home equity line or loan is that you only pay interest on the amount of the money you actually use. So it can be a good thing to have a line available, not use it unless you have to. But two negatives of that is that, one, monthly repayments are required. So once you have a balance, you have to make a payment every month. And the other
Mhm.
thing is that draw periods are really limited, typically to 5 to 10, probably 10 years is the most common one, where you can access the money for 10 years, but then
Mhm.
it converts to a fixed rate loan after that that you have to pay back, usually on a 20-year amortization. And the other thing is that a credit line can always be, as we learned in 2008, the financial institutions can decide to either cap them or shut them down, if they feel that there's a risk to them.
Mhm.
So a third way for a person who's over 62 is a home equity conversion mortgage, and that's designed specifically for people that, as I said, are over 62. And the really shining thing about it is that no monthly payment is required, right? So that's a really important thing. There are adjustable and fixed rate options, and the loan is FHA insured. So a couple of characteristics that the FHA uh, insurance brings in is that, one, it's a non-recourse loan, so the person can never be charged for the loan balance.
Mhm.
It can never be. It's only secured by the house. Um, and also, the FHA insurance, even if the balance of the loan goes higher than the value of the house, the FHA insurance takes care of that loss, not the person, not the heirs.
Mhm.
So in
Mhm.
a lot of ways, it's a lot more safe of a loan than the other alternative of a credit line,
Mhm.
as you'll see. So we can go to the next slide, and let's talk about the reasons why somebody would possibly want to do a reverse mortgage. Um, Mortgage payment cancellation is probably the biggest one. So if you get a reverse mortgage, you're not required to make a payment. You can make a payment if you choose to do it, but you're not required to do that. And yes, of course, the interest gets added on to the balance, and the balance can increase. That is, possibility of that. But
Mhm.
nevertheless, no matter what happens, once you have it in place, you do not have to make a payment. So another reason why people want to do it is that it gives them an ability to age in place, right? Because they can access capital, and they can use it to foil some of those risks that we talked about, or some of those behaviors that we talked about that get in the way of self-actualizing their retirement.
Mhm.
So that's another reason. Also, people use it as reserve funds for repairs, expenses, contingencies. You can use the funds for debt consolidation as well. You can pay off, monthly debts and try and get your payments down into a reasonable place.
Mhm.
So those are some basic ones for people that would really might need the mortgage. But then on top of that, there are some other things that it does for people that wouldn't necessarily have to have the mortgage, but can use it as a very positive financial planning instrument. And that is for example, tax planning, where you can, where it gives you some flexibility with regards to how you take your IRA distributions, whether you do or do not use Roth conversions. And you can use it as kind of income replacement in situations where you can advantage yourself, because one of the things about the proceeds from a reverse mortgage that they're not considered ordinary income.
Hmm.
So you can put them in place of a situation where you don't want to incur income that will raise your taxes, but you need money. You can
Mhm.
utilize the reverse mortgage for that. It also, another thing is, it protects retirement assets from sequence of return risk. And what that means, you know, really quickly, is if you have assets and the market goes down, your assets, of course, shrink. If you're spending from those assets during that period of time, it's much more difficult for those assets to then recover and return back to the value that they were,
Mhm.
when you had them to begin with, before the loss. So one of the things you can do is utilize the reverse mortgage to protect yourself in times when the assets shrink. You can utilize funds from the reverse mortgage, and thus giving the assets time to recover,
Mhm. Mhm.
in a better market. And then also medical and long-term care expenses. You can use the proceeds for those. You can either purchase a long-term care policy, as you mentioned earlier when we were talking, Kevin, or you can utilize the funds as a hedge against future expenses, because one of the features of a reverse mortgage, or at least one type of them, is that you can have it as a credit line, and you can have the money
Oh.
sitting and um, waiting for expenses that you might have.
Mhm.
Another reason is that you can delay in utilizing your Social Security funds until maximum benefit.
Mhm.
One of the things is, if you start spending your Social Security, or start receiving your Social Security at 62, you get a certain level. It's probably about an 8% per year return on investment if you don't take the money, right? So
Mhm.
that's something to think about, because if you can put off taking your Social Security to a much later age, you're earning at least 8% a year annualized over the next, the rest of your life,
Right.
right? And
Mhm.
part of it is, do you look at Social Security as just income, or do you look at it as a retirement insurance benefit? Right.
Mhm.
And if you look at it as a retirement insurance benefit, then being able to delay taking it really enhances the benefit as well.
Right.
So, and then another thing that comes up a lot of times is, you can use it as a reserve for declining Social Security because of the loss of spouse. Because one of the things that happens is, when one spouse dies, again, if you have one, if one spouse dies, the other person's Social Security gets reduced typically,
Mm.
because either if both people were receiving Social Security, now only one person's receiving it, or if only one person was receiving it, they get the lower amount, right? And
Mhm.
then also another reason is, you can use a reverse mortgage to purchase a new home that better suits you as well. And
Mhm.
so those are all reasons why somebody might use a reverse mortgage. So we go to the next slide.
Mhm.
Who's eligible for this? Well, you know, people that are 62 years or older. There are some private reverse mortgage products that allow people as young as 55 to access them, but we're really not talking about those in this presentation. We could
Mhm.
do those in another one. You have to live in your home as your principal residence, and you have to be able to pay the property taxes, insurance, and HOA dues on the property. So that's really who can access this money, is anybody. And you do have to minimally qualify income wise to be able to pay the property taxes, insurance, and HOA dues.
Mhm.
So if you go to
What
the
if
next,
you live in a duplex, and let's say you live in one unit and rent out the other one?
very
Would you
good
still
point.
be eligible?
Yes, yes, absolutely. 1 to 4 units, as long as you live in the property.
Okay.
So that's a really good question, and that is a method that some people use to create income. Right? Is they do
Right.
buy a 4 unit or 3 unit or property, and then use the income to help sustain themselves in retirement.
Right. Right.
So how do you receive your money? So a couple of different ways. You can get all your money that you qualify for as a lump sum at closing, and that's typically if you do the fixed rate product.
Mhm.
And contrary to the way the mortgage market is and the forward mortgages, most people do not choose to do the fixed rate uh,
Mm.
loan, and you'll see why in a couple of minutes. Um, but anyway, if you do a fixed rate loan, you get all the money all at once. A line of credit, it allows you to draw funds at your discretion, right? So
Mhm.
that you can actually take the funds, whenever you want. You
Right.
just access them just as you would with any credit line. Then there's also a 10-year payment, which is equal monthly installments for as long as you live in the home.
Mm.
or any combination of the above. And also there's another one that I left out on the slide that's called a term, where you say for a certain period of time, I want a certain amount of money. So those
Mm.
are all different ways, and you can combine, those last three together or separately or whatever. So there's a lot of flexibility in terms of how you receive the funds.
Mhm.
So let's go to the next slide. Now, another interesting thing, and we were just talking about, or I was just talking about why most people choose to do the adjustable, and that is because of another feature of the line of credit. Unlike a regular line of credit where you get a certain amount and that's what you have, this line of credit actually grows per year by the
Mm.
interest rate of the mortgage. So if you're paying a 6% or 8%, let's call it 8%. If you're paying 8% on the interest on this money, and again, on an adjustable, you only pay on the amount that you actually utilize or spend.
Mhm.
The rest of the money that's sitting in the credit line will grow at an amount of the same interest rate of 8%. Now,
Oh.
that does not mean you're earning money on it. You are not. But what you are earning is access to your capital, right?
Mm.
So if say your credit line balance is 200,000, and then your rate is 8%, at the end of the year, if you don't access any of that money, your credit line balance would be more like 216,000.
Oh,
And
interesting.
that can grow every year, regardless of what happens to the value of your home, by the way. So even if your home value were to drop, your line of credit still grows, right? Because
Mm.
again, go back to the insurance, um, that will access the um, that will protect any loss that we
Mhm.
have in the
Oh, the FHA insurance, right. It'll protect the lender from a
protects the
loss that will
lender, and it
to the
also
value.
protects the person because there's no recourse on this loan at all.
Right, right.
So just the thing to get out of this is your line of credit can increase per year on the amount that you don't spend. So a lot of times people will get the loan, not draw any money or draw very little money at the beginning, and then allow it to grow, for the future, right?
Mhm.
Because if, as you can see, from the slide, I mean, it can double in, a fairly short period, well, called relatively short period of time, right?
Mhm. Mhm.
So, so that's another reason why people really like the adjustable. And then,
And
go ahead. I'm
do
sorry.
do the increases, so let's just say the first year it was 200 and then it increases to 216. Are there increases on the increases? In other words,
Yes.
you get 8% of the 216 the
Yeah,
next
that's your
year.
balance, right? It's 8% of your balance on an ongoing basis, right?
Okay, wow. So the rule of 72 would apply in theory.
Yes, that's right. Yeah.
Fantastic.
So let's go to the next slide, and just talk about equity for a second, because another part of it is everybody always focuses on, oh, my balance is going to go up. I'm losing all my equity. I'm not going to, this loan's going to end up, there'll be nothing left. You know,
Mhm.
people say a lot of those kinds of things. But in fact, if you really look at the possibilities, depending on how you manage it,
Mhm.
um, you can have very positive outcomes with regards to it. And if you look at the graph, the purple is the balance of the loan.
Mhm.
The aqua is the property value, and the equity is how much you have in the home is the green. And as you can see, they're all increasing,
Mhm.
right? So, I mean, if you have a fairly stable increase of value, say, usually in presentations we use anywhere from 4 to 6%,
Mhm.
which, over the last 20 to 30 years is probably pretty good if you didn't happen to measure it in 2009, right? But, you know, for the most part, the average of that over the period of time, 4% is fairly reasonable. And you can see that, yes, your loan balance is increasing, but also your equity can potentially increase. And the value of your property hopefully will increase as well.
Hmm.
So we can go to the next slide. And then let's talk about what happens later. So as this goes on, if you get the loan, you can remain in your home for as long as you occupy it as your principal residence and you pay your property taxes and insurance without making a payment. So
Hmm.
that's like feature number one, right? You
Hmm.
can also choose to make payments on the principal and or the interest, but you're not obligated to do so. And when you cease to occupy your home, or your heirs, if you are deceased, can choose one of these three options, right?
Hmm.
You can either pay off the mortgage and retain the home.
Hmm.
You can sell the home and pay off the mortgage with the proceeds of the sale and keep whatever's left after that. Or you can return the property to the lender with a deed in lieu of foreclosure.
Hmm.
So the important thing to remember about this is that there's no recourse ever to the borrower or the heir. So nobody is ever going to end up, oh my God, I owe $50,000 because the reverse mortgage did this, the reverse mortgage did that.
Right.
Um, and again, just to reiterate, remember that the balance increases on the reverse mortgage, the value of the property can increase as well.
Hmm.
Right.
Now,
So
could the heirs potentially refinance the property to pay off
yes.
the reverse mortgage? Okay.
Yes. And one of the other things to mention really quickly is that they will never have to pay more than 95% of the appraised value of the property at the time when they're doing that.
Oh, okay.
So let's say, for example, the worst happens, values go down, interest rates go up, the mortgage gets to be bigger. Maybe it's a $600,000 home and the mortgage is now at 800,000.
Hmm.
With a FHA HECM, the heirs can either refinance. Well, refinancing would be harder, right? Because the value would be harder, but they can pay the mortgage or purchase the home at 95% of the current appraised value at the 600. So that's a
So,
really good feature as well.
right. So presumably they could buy the house, or they, in essence, pay off the loan at about roughly $590,000.
Right,
And, perhaps they could, get a 80% loan on the house and come up with 15% in cash,
right,
and they would still be able to retain the home.
right. And their
How
basis in the home would be at the value that they got it at the time. So
Right. And how long after the owner passes away, how long after that would the heirs have to, pay off the mortgage and or sell the house, etc.?
so so the short answer to your question is it basically starts with a period of about 3 months. And then you can ask for two extensions.
Mhm.
You can ask for an extension to 6 months and you can ask for an extension to a year.
Mm.
So, theoretically, and I shouldn't say theoretically, because by practice, typically, you can get that long if your situation dictates it. But,
Okay.
keep in mind that the longer it takes you to do that, the mortgage is still at work, right? It's
Mhm.
still accruing cost, and payments are being not payments are being applied, but the lack of payments is increasing the mortgage
The
balance
mortgage
as
balance,
well.
right? Uh-huh. Okay.
So,
Interesting.
and so last slide is what's your plan for retirement, because that's the really important
Hmm.
thing for everybody to know. And I would just say one thing: this loan can do a lot of different things. It cannot do all of them at once, right?
Hmm.
So for the person who really needs the money for debt consolidation, or really needs the money for income, or really needs the money to fix their home or to stay in it, if you're going to use the majority of the money, some of the financial planning things we talked about aren't really going to take place, other than the fact that no matter what, you're not going to have to make the mortgage payment that you would if you utilize the mortgage to do that.
Mm-hmm.
So that's like the shining again. That's feature number one. But then all these other things, depending on your financial situation, um, you know, if you have a situation where long-term care is your worry, or delaying Social Security is your worry, or you can use it for those kinds of things. What you have to balance is what's the cost of doing that
Mm-hmm.
with this instrument versus the cost of not doing those things, right?
Mm-hmm.
And that's a lot of times, people don't talk about that as much. That's a very important factor as well, right?
Mm-hmm.
Is you do have to look at the cost, but there are a lot of things and a lot of techniques in the financial planning thing where you actually, I mean, if you just talk about an IRA distribution, you're paying, regular tax rates on that, right? Ordinary income rates, 20-30%. Well, if it costs you 7 or 8% a year to do that, perhaps that could be a good decision in certain situations.
Mm-hmm.
Or, and another thing that people utilize is there's you do get, and again, this isn't tax advice, right? So this is just talking about what is possible.
Mm-hmm.
But as you accumulate, as the loan goes on, you're accumulating an interest cost. If you choose to pay that interest, that
Mm-hmm.
then can become a deduction. So
Oh.
a lot of times people use that to do planning with Roth conversions where they can come up with a certain a certain amount of deductions that shelter the cost of doing those things. So
Mm-hmm.
there are a lot of things like that. We've just kind of touched on the surface of it. And the
Right.
most important point is every person's situation is different, right?
Mm-hmm.
So there isn't a thing that says, oh, debt is terrible or debt is wonderful. It's not about that. It's about your situation and how does this affect you and what can you do with it,
Mm-hmm.
right? To
Mm-hmm.
help yourself with the aid, I would say, of financial professionals, right?
Right.
You should definitely have a financial planner. You should definitely have somebody who understands, your real estate and how to position it. And, we didn't even talk about rental properties and so forth and so on, which
Right.
you can't use a reverse mortgage for rental properties, but you can use a reverse mortgage to increase your cash flow that can
Mm-hmm.
allow you to own more rental properties. Or as you said, you could buy a duplex or a triplex or a fourplex and utilize the income for that. So
Yeah.
there's just lots of different things. It's a great product, used properly, thought out, planned, and it does a lot of good for a lot of people. So
So one question, because we're actually a little bit over time here, but I think this is important. Um, if somebody already has a mortgage on their home,
mhm.
can they still get a reverse mortgage? And if so, what happens to that existing mortgage?
So two answers to that. To get the actual reverse mortgage that we're talking about here, you would pay off that mortgage. So in other words, if the person has a property, it's worth 800,000 and they have a mortgage of 300,000, they perhaps could qualify for a reverse for 5.
Mhm.
300 would pay off that mortgage, and then the remaining 2 would be available, in simplicity. There
Okay.
is another product out. It's proprietary. It is a second mortgage, and
Oh.
it allows you to go behind an existing mortgage. So for the person who got the 2% interest rate 3 or 4 years ago, right, who
Hmm.
doesn't want to give that up, who sees that as a important thing, but also needs help, that second mortgage product could come into play. It's a fixed rate product and no payments are required as well. So
Hmm.
you can get this second mortgage and so say you could borrow 50, 100, maybe 150,
Hmm.
however much. And again, you would make no payments on it if that's what you chose to do. Or you could make some payments on it to keep the reverse amortization down if you wanted to do that.
Right. Right.
Anyway.
Interesting. In both of those cases where you have that low interest rate, you may be better off keeping it and you know.
Yeah, that would be a decision. And, and a lot of this is based on time factor. That's why the slide about the number one question, to the extent that you can plan where you want to be and how you want to be there, you can make the best decisions then, right? Because you can
Mhm.
tailor what you're doing to that. One of the worst things you can do is get a reverse mortgage and then sell your house 6 months or a year later,
Mm.
because the cost of doing it versus the time that you have it are, it just it doesn't pencil out. There's always other ways to sustain yourself for that period of time. So it's
Right.
more a product for the longer term, for
Mhm.
somebody who wants to stay in the home or buy another home that they want to stay in.
Mm.
And
Mhm.
to just touch on and I know we're running short of time, but to just touch on the purchase. So the purchase can work the same way. Let's say that you have a property that you want to buy and you're looking around and your budget's 400,000 and you can't find anything for 400,000, but you could find something for 600,000.
Mhm.
Well, you can get a reverse mortgage for, again, 40, 50% of the purchase price, which would then, if you have 400,000, that would give you enough money to go up and buy the higher property. And the features of it are basically the same. It can be fixed or adjustable. And, um, a lot more people
Mm.
use fixed in that situation because they're getting a finite amount of money for the purchase. But
Right.
some people use adjustable as well.
Interesting. So you can sort of leverage your acquisition dollars.
Yes.
Yeah.
Right.
See. Well, Tom, this was fascinating. Like I said at the beginning, I know very little about reverse mortgages, and they're much more flexible, and they appear to be just a great tool for people to discuss with their financial planning professionals, their accountant, lawyer, whoever they're dealing with. So I really appreciate you coming on the show today to talk about this and help people understand, what they're really all about. So thank you so much for being on the show today.
Well, my pleasure. Thanks for having me. And I really appreciate the opportunity to chat with you.
So I'm going to have you hang on for a minute, and I'm just going to wrap things up, and then we can chat for a minute after we go offline. So, folks, that's a show for today, and I encourage you to take a second look at this show. There was a lot packed into this time, and I think that you may have a number of questions. So I'm going to put Tom's contact information in the show notes. And I'm sure, Tom, if people want to reach out to you with questions, you'll be happy to
Happy to do that.
answer
Yeah,
those. Yeah, more than
absolutely.
happy to answer them. And that way, you can educate yourself and be better prepared to talk to your advisors. So, just real quickly, tomorrow at 10 a.m. is my show, Business Lessons from the Military, and then on Wednesday at 10 a.m., these are all Pacific time, by the way, is People Making Money. So a couple more times for us to be together this week. Thank you so much for joining me today, and signing off as I always do. Bell. Marie, you are my Bell. Thanks so much, folks. Hope to see you later this week.